Let's discuss what is mutual fund and how we can benefit from investing through it. A mutual fund is a collective investment scheme which specializes in investing a pool of money collected from investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. There are two types of mutual fund. First one is open-ended. These are mutual funds which continually create new units or redeem issued units on demand. They are also called unit trusts. The unit holders buy the units of the fund or may redeem them on a continuous basis at the prevailing net asset value. Second one is close-ended. These funds have a fixed number of shares like a public company and are floated through an initial public offering. Once issued, they can be bought and sold at the market rates in secondary market like stock exchange. Now we will look at the structure of mutual funds. There are 5 players involved. 1. Trustee, which is also called the custodian of the funds. Next is stock exchange. Third is investor, also called the unit holder. Fourth one is asset management company, which ensures that the fund manager takes the investment decisions within the defined investment policy of the mutual fund. Last one is SECP, who is the regulator of mutual fund industry. The risk-return spectrum of mutual funds climbs steadily. Money market funds offer low risk and low returns, ideal for parking cash. Income funds aim for steady income with slightly higher risk, while balanced funds mix stocks and bonds for moderate risk and return. Asset allocation funds diversify across asset classes for a balance between risk and return depending on the chosen mix. Finally, equity funds invest primarily in stocks, offering potentially high returns but with the highest risk due to stock market fluctuations. Now look at the net asset value, which is calculated based on the given formula. Further, in order to determine the sale price of the unit, sales load is added to the NAV. In case there is no sales load, the NAV will be the sale price as well as the redemption price. There are various kinds of categories of mutual fund. We will be looking at some of funds to get the brief idea. First one is money market fund. Money market funds are among the safest and most stable of all the different types of mutual funds. These funds invest in short-term debt instruments such as treasury bills and bank deposits. Next is income funds. These funds focus on providing investors with a steady stream of fixed income. They invest in short-term and long-term debt instruments like TFCs, government securities like T-bills, PIBs, or preference shares. Third one is balanced. Balanced funds offer a one-stop shop, combining stocks for growth potential and debt for steady income. This diversification aims to balance risk and reward within a single investment. Fourth one is asset allocation. These funds may invest its assets in any type of securities at any time in order to diversify its assets across multiple types of securities and investment styles available in the market. Last one is equity funds. An equity scheme or equity fund is a fund that invests in equities, more commonly known as stocks. The objective of an equity fund is long-term growth through capital appreciation, although dividends and capital gain realized are also sources of revenue. That's it for now. Thank you. For sales support, reach out to your regional sales managers, team leaders, or investment relationship manager.